Valvoline. It's a brand that's been around for over 150 years. You've definitely seen it, but the company you see today has gone through this absolutely massive transformation. So for an investor, the real question is, what is it now? Is it this high-octane growth stock, or is it a company driving straight into an electric vehicle roadblock? Let's dig in and figure out if Valvoline is gearing up for the future, or if it's a relic about to hit a wall.
And that's really the big question here, isn't it? This is the central conflict. You've got this powerhouse brand on one side with a model that just works, and on the other, you have this huge technological shift that threatens the very core of its business. So we're going to look at this from every angle, right now.
So to really get what Valvoline is today as an investment, you got to know about this huge pivot they just made, because I promise you, this is not the same old company you might think it is.
Okay, so this is really the key to the whole strategy. The old Valvoline was kind of doing two things at once. It was making lubricants and oils, which is a really tough, expensive business, and it was also running service centers. The new Valvoline, it's laser-focused. They sold off that entire manufacturing business to become a pure-play service company. And that's a move investors tend to love, because it usually means higher profit margins and a much cleaner, simpler growth story.
And we're not talking about a small change here. This was huge. They sold that global products division to the oil giant Aramco for a jaw-dropping $2.65 billion in cash. That move completely simplified the business. And just like that, they had this massive war chest to pour into their new service-only strategy. So let's see how that cash is building the bull case.
All right, so they've got the cash, they've got the focus. What's the bull case? Why are some investors so excited about this company? Well, it's really built on two things: incredible consistency and a super clear roadmap for growth.
Just look at this number, 18. 18 years in a row that their existing stores have grown their sales. I mean, think about that. That's through the Great Recession, a global pandemic, you name it. For an investor, that kind of all-weather performance, that's the gold standard. So how do they pull that off? It's all about this super simple promise. Their secret sauce is the stay-in-your-car super fast service. You're in and out in about 15 minutes. It's incredibly convenient, and it builds this sense of trust with customers. That's the engine that just keeps people coming back again and again.
Now, the oil change is obviously the star of the show, making up almost 3/4 of their sales. But here's the really crucial part of the strategy for investors: that growing slice for non-oil change services. We're talking about things like battery replacements, tire rotations, changing other fluids. These are often higher margin jobs, which just means more profit on every car that rolls in. Getting customers to add one of these services is a huge focus for them.
And a huge reason they can grow so fast is their franchise model. I mean, look at these numbers, they're just nuts. The average Valvoline store brings in over $1.5 million a year. That's more than 50% higher than the rest of the industry. So if you're a potential business owner looking to open a franchise, which one are you going to pick? It's kind of a no-brainer. And with franchisees basically lining up, that leads directly to this: management's land grab strategy. They look at the market and see a ton of small, independent shops. So they see this window of opportunity to go out and consolidate the industry. The big goal, go from around 2,000 stores today to 3,500. That is seriously aggressive. And look, this isn't just some pie-in-the-sky dream. They're actually doing it. You can see the steady climb, adding hundreds of stores over the last few years. And their own forecast shows they're planning to step on the gas even more. This is exactly the kind of predictable growth that gets investors excited. But all of this is happening in a world that's changing fast, which brings us to the bear case. Okay, so the growth story sounds pretty amazing, right? But there is a huge but. A massive electric roadblock sitting right in the middle of the highway, and everybody can see it coming.
You know, there's just no way to sugarcoat this. The single biggest risk to Valvoline's entire business is that the very heart of their business model, the thing that gets customers in the door 2 or 3 times a year, well, electric cars don't need oil changes at all. This isn't just a small problem, it is an existential threat.
See, it all boils down to how often a car comes in and how much money you make when it does. A gas-powered car, an ICE vehicle, is like a subscription for Valvoline. It needs frequent, regular service. An EV, on the other hand, just has way simpler needs. Sure, they can do tire rotations and brake fluid on an EV, but those visits are way less frequent and usually bring in less money. The bottom line is, every EV that replaces a gas car on the road is a net loss for Valvoline's business as we know it today.
And if the whole EV thing wasn't enough, they're also fighting a war on another front. This market is an absolute dogfight. You've got Jiffy Lube, owned by Shell, right there with them. And then there's Take 5, which has been growing at a blistering pace. We're talking from just 65 stores to almost 1,200 in under a decade. It is a fierce race for market share. So as an investor, this is the puzzle you have to solve. On one hand, you have this fantastic company with a proven growth plan. On the other, you have this massive technological disruption heading straight for it. It really is a race against time.
So what's the bull's answer to this giant EV problem? Well, it's this idea called the ice harvest thesis. The argument goes like this. Hey, the switch to EVs is going to take decades. Right now, there are about 280 million gas cars on the roads in the US, and they aren't just going to vanish overnight. That creates this really long, predictable, and profitable stream of cash flow from oil changes that could last for years and years, giving Valvoline the money it needs to keep growing and figure out its EV strategy.
So if you're actually thinking about investing in Valvoline, or just watching the company, these are the 3 numbers to look at every quarter. First, same-store sales growth. Are the existing stores still healthy and growing? Second, net new stores. Are they hitting those aggressive expansion targets? And finally, profit margins. Are they staying efficient as they get bigger? These numbers will tell you if that ice harvest is actually on track.
Now here's the catch. The market sees all this quality and growth, and it makes you pay up for it. Valvoline trades at a forward PE ratio of over 23. That's a huge premium compared to other auto retail companies like Asbury or Group 1. The big question you have to ask yourself is this company's growth story so good that it's worth paying more than double what you'd pay for its competitors?
And that really brings us back to the ultimate question. Is Valvoline skillfully harvesting the long, slow, but profitable decline of the gas engine to build a service empire that will last? Or is it just a melting ice cube, a really fantastic business that's facing a slow, inevitable death by technology? That is the billion-dollar question you, as an investor, have to answer.